I'm Kerry Savran, President of the Beenleigh Yatala Chamber of Commerce. It gives me great pleasure to introduce to you tonight's guest. Chris Cook is a highly experienced insolvency practitioner operating in the corporate, personal and insolvency profession for over 20 years. Chris gives stakeholders advice on business recovery, restructuring, turnaround management and undertakes insolvency appointments as required. He's been employed at Worrell's Solvency and Forensic Accountant since February 1999, and he became a partner of the firm in July 2007. Now, during his career, he's had a substantial experience in a wide and diverse range of industries, including building and construction, retail, transport, commercial property, hospitality, manufacturing, mining services, printing, telecommunications, technology, and warehousing. Over the years, Chris has been appointed to a large number of entities. His strong record in pragmatic decision-making and effective communication has maximised results for stakeholders. Tonight, he is here to talk to us about implementing strategies to help combat the effects of COVID-19. You'll be really, really excited to hear what he has to say. So, Chris, I'm going to leave it to you.
Thanks very much, Kerry, and thank you very much for having me along. This is certainly a topic I'm quite passionate about, given the current environment of the challenges of COVID-19 and what it's had on the impact of the businesses out there. So what we are talking about today is exactly that, combating the effect of COVID-19. What we'll do is we'll run through some tools that are available in assisting businesses travel through these difficult times. We'll talk about some short-term cash flow issues and ways of addressing them, some longer-term strategies, and then give a bit of a case study at the end of all of this as to what might be an opportunity if everything else fails and it needs to go through a formal restructure. So I'm hoping I sort of set out a number of different strategies along the way. Now, of course, before I get in, I might just, if I may, just table a disclaimer, of course, just reminding everybody today's discussion is of a general nature. It's not specific advice. If anyone wants to talk about anything specific, absolutely, please feel free to contact me and I'm more than happy to talk about that. Well, what an interesting 4 months it's been, I must say. I remember back at the start of the year in January, I was fortunate enough to spend a week over at Moreton Island, sunning myself on the beach, certainly not worrying about social distancing, I must say. And I was sitting there on the 1st of January, perhaps nursing a little bit of a hangover, thinking about, well, what's, as you do at that time of year, what's 2020 going to bring? And in doing that, I started to reflect upon 2019, and particularly in the sort of business space and where businesses probably were struggling through that time period, what was doing well. And I was sort of thinking to myself, it'd been a difficult time for retail, change, which were struggling at that time due to the high pressure of the online market. The bricks and mortar store with rent and all the rest of it was putting some pressure on them. Tourism and hospitality, it was doing okay, but certainly tourism was under a bit of pressure. The automotive industry, particularly in the southern states, had taken a bit of a hit with some of the factories closing down and the flow-on effect through the SME market. The mining sector was doing very well. It was good to see that bouncing back, so that was quite good. The transport industry also was starting to improve a bit off the back of a lot more package deliveries. So I was just sort of reflecting on all of that as one does and thinking about, well, what's 2020 going to look like? I sort of thought, well, retail will probably struggle a little bit. I didn't see that changing anytime soon, much the same as tourism and manufacturing, to be honest. I thought mining would continue to improve and move ahead, which would be good. I certainly had, at that point, we're still in the drought, and I was hoping for some rain. The long-term forecast had certainly suggested some rain would be on the way. So hopeful we'd see agriculture improve. But I must say, in all of those considerations, at no time did I expect in a couple of months' time we'll be sitting with a worldwide pandemic, which of course has led to the closure of international borders, closure of even state borders. I wouldn't have believed it unless I'd seen it myself, probably. So it's certainly been a very challenging time for many businesses. And this is where we're finding many business owners now, moving on to today's topic, is they're finding themselves in a unique position whereby for the first time they're having to actually look inwards on their businesses and to contemplate financial decisions that, quite frankly, they've never had to worry about before. They've had good, sound businesses. Then all of a sudden, all these restrictions and all these limitations on business and the ability for a lot of businesses to trade was taken away from them through no fault of their own. And we've certainly seen the government do its very best to adapt to that by providing, of course, the stimulus packages they've done, changing some laws to try and help through that process. And I think, quite frankly, I think they've done a good job. It's been a challenging time, and they've tried to nurse everybody through that first short period. But now it's time to get back to business. It's time to get back onto that horse and address the short-term and long-term issues of those businesses that are finding it tough in these times. And it's probably safe to say that many businesses, things are not just going to turn back to the way they were. There's not going to be a magic period when we get to end of September and the restrictions are hopefully eased up considerably. At that point, of course, the government stimulus is pegged to stop. So businesses are going to be back out on their own and having to fend for themselves. And I'll talk a little bit about that as we go on through today. But the concern is, of course, the revenue is not just going to magically go back to what it was. So the businesses need to start planning for that now. They've had the opportunity to sort of take a bit of a shock, as all of us have in these current times. But it is really time to get back on with it now and do our best to get through all this. So in doing that today, we're going to talk about some of the tools that are available and hopefully assisting businesses in getting back on with it. I'm going to talk about some short-term strategies, and this is for the period between March and September. Of course, we're a couple of months into that now, but I've intentionally picked that date being the date that the stimulus is available, the date that the laws have changed from government, and of course, the dates where government restrictions on social distancing and businesses being able to trade, the period to which that happens. Then I'm going to look at the longer term strategy. So this is the period from September 20 onwards, when businesses will have to fend for themselves a little more. So when we run through the short-term analysis, we're going to have a quick chat about assessing the current financial position of a business. The fact that cash is king during these challenging times. We're going to have a quick look at identifying what stimulus options are available. Now, I'm not going to dive into these in any detail. There is considerable media and information out there now on all of this, and I'm sure many of us are already across all of this. So I'm going to do nothing more than identify them. I'm not going to go through qualifying criteria or anything of that nature. There's plenty in that space. I'm going to talk about what other measures outside government stimulus, what else can businesses be doing in this short-term period to help their businesses survive these challenging times. And also going to look at making that decision. Can the business survive for the short term? We'll then move into the longer term analysis. We'll adopt a similar approach. We'll look at the long-term cash flow. We'll talk about what other measures outside of the ones we'd already discussed for the short term may be available for the long term for business. We'll talk about developing a plan for this deferred debt. And this is my biggest fear. The fact that businesses are deferring, many businesses, certainly not all of them, but many businesses are in a scenario where they have to defer debt, whether it's paying the landlord less and deferring the debt, whether it's going on loan repayment holidays from the bank, whatever it is, the debt is still there. So what's their plan to address that? So we're going to talk about that. We're also then going to talk about getting key stakeholder support in the long-term plan and then implementing the strategy, assuming it's going to provide the results that we want it to. So starting through this process, through this journey, first is assessing the current financial position of the company, the business, sorry. And this is what's critical. To take stock. They've got in a situation, and many businesses may have already undertaken this task by now, but it's still important to make, if they haven't, they need to. And that's sit down with their financials, have a good look at their current financial position. They want to do this to make sure, firstly, it allows them to understand the current position of the business. They can then use this information to determine whether they qualify for any of the government stimulus packages. And then this will then provide them with an understanding of the future cash flow of the business and to assist in developing that strategy in going forward in terms of giving their business the best strength that it can be in, the best position that it can be in through this 6-month period. Now, just a reminder, I'm talking about the period up to September 2020 only. Some of these strategies we're going to talk about are designed only for that period, and it'll become a bit more obvious as we talk through these. Now, of course, what is of utmost importance during this period is the fact that these businesses make sure they are realistic in their cash flow projections. This is not the time to do it with rose-coloured glasses. It's the time to be objective and realistic on what is going to happen until September 2020. Now, of course, that's quite easy for me to sit here and say that when these are uncharted waters. These are challenging times, and many businesses' revenue is affected by when government restrictions are eased and what impact that has. So it's not an easy task at all, and I don't suggest it lightly. But it is a necessary one. It is absolutely necessary to prepare those cash flows to see where your business sits. And these cash flows, without taking advantage of any government stimulus or any of the other strategies I'm about to talk about, will present some information just looking at them before we get down to what you can do to remedy those. The first is there'll be businesses will be broken up into three broad categories, in my opinion. The first is those businesses that are forced to hibernate. And these are the ones where the business revenue has been that severely impacted by the government restrictions that they're largely incapable of producing any revenue at all, or if they are producing revenue of such a small scale that it's simply not possible to open the doors. Now, this could be some restaurants, some cafes, event management businesses. Of course, they're not operating at the moment, and the like. So those businesses have had no choice but to hibernate. That's one category. The second category is that of those that can trade, but their revenue has been severely compromised by the government regulations. Their revenue has been that affected materially that they are able to trade, but it has had a large impact on that revenue. And as such, they've had a decrease in profit, potentially to the stage where it's a loss. And they may not be able to trade as a result in a profitable manner in the current circumstances without taking advantage of some of these strategies that I'm talking about. And of course, these businesses currently are quickly trying to work out and what they can do to keep their business going for this short-term period. Then there's a third category, which is the category I'm not really going to talk about today. And these are the ones that are actually doing okay. There are absolutely some businesses out there that are doing quite well, been largely unaffected by the current period. Or in fact, some businesses they're actually doing better. They're in a unique position where they are actually performing better than they were pre-COVID. So certainly, and those businesses, they don't need to be having the discussions and considering the strategies that we're going to be talking about today. So getting into the second step. So the first step, assume we've done the cash flow, we've done it as best we can in an objective manner, in a realistic manner. So now we've got some numbers on the page. So what do they tell us? What should we be doing? Now, I'm taking the assumption that some of these government stimulus options may well be available if they've hit those different criteria. So again, I'm not going to go through them in any great detail, but rather than to talk about them, to make sure that they're things that all businesses are considering. And if today happens and anyone that watches today goes away with only one or two things that perhaps hadn't been considered beforehand, that would be great. And that will hopefully help these businesses. Now, the first one is JobKeeper. That's an obvious one. And this initiative is absolutely keeping businesses going. I've seen that time and time again. Without this package, there's many businesses that would have been unable to trade during this current period. So it's been a welcome relief for a lot of businesses. And of course, it's just a process, as we all know, of $1,500 being funded by the government per employee per fortnight. The businesses have to outlay the money first and they get reimbursed by the government. We've seen some assistance through payroll tax relief for those businesses that are liable to pay payroll. And we've seen the PAYG cash boost come in, either money going into their account or credits against their PAYG. But one I want to talk about certainly is that of rent relief. I'm sure this is one many have taken advantage of, but if not, it's definitely something to look at. If a business can demonstrate that they've been affected by COVID, then there is the option for them to look at seeking some rent relief from the landlord. Now, this was announced by the government probably 6 or 7 weeks ago now. And the idea of this landlord-tenant code that was put in place was to give the tenants some confidence that they are not going to be affected, that they can't be simply evicted from their premises should they be unable to pay the rent. And it also gives them, it paves the way for them to speak with their landlords and open up a communication line about developing a plan and a strategy going forward to help each other out through these difficult times. Because the landlord doesn't want to lose a tenant because they're not going to get a new one in this current time. So really, they both have got something to win and lose out of this. So the idea was that this code would open up that communication line where if they could demonstrate they had been affected by COVID, so if they were affected, say the revenue had gone down by 30%, the concept was, well, half of that revenue decrease would be a debt waiver for 6 months, and then the other half would be not payable now, but payable over the duration of the lease. So if the business had a 30% reduction in their revenue, then their rent bill would only be 70% during this current period, with 15% of that a waiver, they don't have to pay it, and the other 15% to be paid off over the balance of their lease. So that's certainly something many businesses have been taking advantage of. And it has now been legislated in Queensland as well, so that's now in place. So it's certainly something businesses should be looking at. But one thing to bear in mind, excuse me, is businesses should not be taking advantage of this initiative or any initiatives of deferring debt if they're able to afford it now, because all they are doing is lumping on and putting up a pile of debt for the future that they still have to pay, because this deferred debt now has to be paid over the balance of the lease. When they won't have any government support, they're going to have to fend for themselves. So it's important that they only take advantage of these initiatives if it means the difference of them making it or not making it. That is critical. There are some temporary changes to insolvency laws that I'd like to touch on. The first is that there's a process where if someone is owed money, a creditor is owed money by a company, and the company is not paying them, they can issue what's called a statutory demand, demanding payment of their money. If that company doesn't pay them, they can, within 21 days, they can then go to court and ultimately have the company put into liquidation. Now that 21-day period in the current 6-month period up to the end of September has been extended from 21 days to 6 months. And the amount, which is ordinarily $2,000, has been increased temporarily to $20,000. So the upshot of that is you're unable to take any legal action to place a company into liquidation that owes you money for the next 6 months. You issue a stat demand, they've got 6 months. So, and the same with bankruptcy. If you've owed money by a person, there is that mechanism to issue a bankruptcy notice and then again to make them bankrupt. Those periods, the threshold amount has been increased from $5,000 to $20,000, same figure as the corporate one, and again, an extension up to 6 months. So they're two things to be very mindful of. There is no way for anybody to enforce by legal proceedings in terms of winding them up or bankrupting any money that they're owed. Now, the mechanism, the idea behind this from the government's point of view was it gives businesses some confidence and relief from anyone that they owe money to, that they can't wind them up and close them down. But one thing that any business needs to bear in mind, of course, it also goes the other way. So if they're owed money from their customers, they can't take any aggressive action to make them pay. So the other customer could say, well, I'm just not paying you. And there's nothing they can do about it. There is one strategy I'll talk about soon, but generally speaking, there's not much that they can do about it. And of course, that then just causes this flow-on effect where no one's getting paid. So it does affect both sides there. So something just to be mindful of. The other insolvency law change, again, a temporary run until the end of September, is there is no current liability imposed upon directors for insolvent trading. So if a director ordinarily trades on a business when it's insolvent and it goes into liquidation, a liquidator can come back and sue them personally, saying the law says you should have stopped trading, you racked up more debt, you've done the wrong thing, you now need to pay the value of the debt that you've racked up during that period. That law has been suspended until the end of September. So anyone out there trading now that's trading insolvently, and if their company was to go into liquidation at a later point, cannot be held personally liable for insolvent trading during this period. If they do it, there are still breaches of director duty possibilities and things like that. They can't negligently go out or dishonestly go out and incur debt, but there's no civil claim from a liquidator. So it is something to bear in mind for all businesses out there. They effectively can trade insolvently, and there's no consequences of that until September. Then it all kicks back in. So it's not a long-term measure. So look, there's some of the government changes and measures available. I now want to move on to what else can businesses do for this short-term period? What are some of those other options? So I'm going to run through a few. Now, some of these may seem obvious, but I'm going to raise them anyway because it's not uncommon we go in to talk to a business owner and we're stepping through some of the things, and these things are real issues that they could deal with, they could implement. So the first one, I'm going to break them up into two categories. I'm going to talk about cash generators. So these are where the object of the initiative or the tool is to generate cash for the short term. And then I'm going to talk about cash deferrers. And that's where the object is to defer debt where they can, to free up that cash to then use on the more urgent expenses. So they're the two categories I'm going to talk about. So I'm going to talk about cash generators first. Now, some of the tools, the first is a tighter debt collection policy. So if you've got a business that has customers that pay on account, this is a strategy that may assist those businesses. Now, the first one is simply to collect all the outstanding debtors outside their trade terms. Now, that seems very obvious, but you'd be surprised how many times we go into a business and they tell us that they're struggling to pay the wages every week. And then we look at their ledger and we see that half their ledger is more than 90 days overdue. And the simple answer is get on the phone, call in the debt that's owed to you, and that will fix up your short-term cash flow issues. Because often, especially when times are tough, The owners or the business owners are out there driving sales. They're all about getting the work in the door, which is great. But their focus hasn't gone on to actually collecting the money for the work they've done. So they need to make sure that they're doing that. So the first easy cash grab, look at the ledger. If there's money owing, get it in. Another one is looking at shorter incentives for shorter time periods for your customers to pay. So if you normally have customers on a 30-day account, well, if they're paying 7 days, offer them a 5% discount because it's going to get the money into your bank faster. Yes, you'll lose out on that 5%, but it'll allow you the opportunity to use that money to pay wages that are a weekly bill. They're not a monthly bill like your accounts are. So you can bring it in and continue to pay those wages on a weekly basis. You could offer significant discounts for really short term. COD, I'll give you a 10% discount to pay cash on delivery. As soon as the goods are about to leave, you get your cash then and there. Now, obviously, it's going to be an incentive. And again, that costs your business some money. But also, you've got to think in the time that we are now. Many businesses out there are struggling. And if you have some concerns about the customer you're dealing with, because communication is key, you need to be talking to them throughout this. You don't just go and implement these changes without having a discussion and working through it and working together, because they're doing it tough too. But if you do have concerns about your customer perhaps paying, if you offer these incentives and they'll think, oh, well, we can get it cheaper, we'll pay them, so they'll pay faster. If they get to the end of the month and they're about to do their normal month-end payments to all their suppliers and they are struggling to have enough to pay anyone, you're not on that list because you got paid 3 weeks earlier because you did it on a discount. So they're here trying to work out how they're going to deal with these different suppliers and having the conversations. You're not part of that journey. You've got your money and you've used your money. So it can help you avoid being in that predicament as well. Another process that is a short-term one, but potentially could cross over into long-term, is just reviewing the internal controls. What happens the day after your account goes overdue? What's the process? There's no point sending in the post a letter with a sticker on it saying 7 days overdue. That's not going to achieve anything. They're not going to pay. You should have a process where somebody is calling them, not emailing them, calling them. Where's the money? Because the loudest barking dog is going to get paid first. So get on the phone, implement a strategy where there's a staff member that knows the second the accounts are overdue and they haven't paid, that you've got somebody chasing it up straight away to make sure you get paid first. So there's some strategies there to get some short-term cash flow in. I mentioned before about the difficulty in having that big stick. You know, the insolvency laws have been moved out, so if they don't pay you, you can't threaten to wind them up. You've lost that ability for this short-term period. But what you can do is you can threaten to cease supply of their goods. If you're a key component of a key supplier of them for whatever their business is, and they're not paying, you just tell them, I'm not going to supply you any more stock until you bring your account up to date. So that is the one tool you do have in your tool belt. You can use that to your advantage. Now, some other changes. It might be a good opportunity to look around the shed. Have you got any stock that's sitting there that's surplus, particularly maybe in the retail industry where you've got some old stock lines that are sort of sitting there and they've been in the back of your mind, but not really been something you've sort of got around to dealing with. Now might be the time. If you've got that scenario, offer a discount, get the stock off the floor, out and convert it to cash. So having a good look at all of your stock lying around. And this also goes for any other assets. So moving on to the next point. If you're a manufacturing business and you've got machinery there that you're no longer using because it relates to a product line that you stopped doing, or you've got vehicles that you're letting the employees use just because you've got them and it's easy enough to let them use, well, let them find their own way to work and sell the vehicle, get some money, convert these surplus assets, whether it be stock, whether it be plant and equipment lying around the place, office furniture, whatever it is, convert it to cash. You're not going to get a lot for it, but you might as well, if you're not using it in any other way, it's of no value to you sitting where it is, so you might as well convert that to cash. Another option might be to consider some finance facilities. If the business is able to get maybe some debtor factoring, again, you can make this a short-term measure. Debtor factoring does cost, but at least if you're selling your accounts, you'll get 70, 80% of that up front to help you with your immediate cash flow. And then, of course, the balance will come in at a later time. So that is an option, but it's something you need to take with care. You don't just want to run in and do that. That finance company may well want some security over your business, may want a personal guarantee from the director. So you need to look at your current circumstances, whether there's any existing charges there, registered charges over the assets of the business, whether you want to offer up that personal guarantee, things like that. So that's not something that's going to be necessarily an option for everyone. But again, today we're just talking about identifying options and then people making the decisions based upon their circumstances. Excuse me. Moving on then now to some of the cash deferrers. So firstly, we're going to talk about some getting rid of some expenses, and then we're going to talk about some deferring ones. So first one is reducing expenses. Now, again, these are short-term strategies. So the first one is staff wages expenses. Now, there's a number of ways this can be done. In these current times, there's the option to stand down staff. So if you've got staff that are unproductive because of the current, you're just not getting the work in the door, whatever the nature of the business is, you can stand them down. Now, the advantage of standing them down, of course, you're not making them redundant, so you're not paying those redundancy costs. They're able to get the government stimulus and get paid some money. And then, of course, as things start to ramp up, you can start bringing them back on. So that's its advantage. During that time period, just bear in mind any entitlements will continue to accrue for those employees. So there's something to bear in mind. The next one would be possibly to reduce staff hours. So if you've done an analysis of your staff productivity and you've worked out your staff are only productive 80% of the time, we'll give everyone a 4-day week. Let them have the 5th day off because they're not doing that 20% anyway. You won't pay them for that 5th day, so they'll go on to a 4-day pay week, but at least they get something in return. They get the day off. And the other thing to bear in mind is they're all out there. Everyone knows what's going on. Everyone's seeing the unemployment rates going up. Everyone's seeing the media pictures of the Centrelink lines. No one wants to be in that predicament. And we found through talking to different businesses how supportive the staff have been. It's been really quite good to see, particularly when it's a good business. It's just going through an unexpected time because of the circumstances. The employees have been very supportive of a lot of businesses. So that they'll know, 4-day week is better than no job at all. Another way to look at another potential change is reducing staff salaries across the board. So not giving them any time off. And we've seen some larger professional firms take on this strategy, whereby everyone in the firm takes a 20% pay cut. So they're still working their 5-day weeks or whatever their agreed terms are, but they're only getting paid, 20% less. Now, the advantage of this, of course, as long as they're productive 100% of the time, then you're getting that 20% bonus of their productivity. But the downside might be, what impact does that have on your staff culture? Are they going to be really happy with that? They may be happy to have a job, so maybe the answer is they're fine with it. But for me, if it's the situation, and are they productive all the time? Because if they're not productive all the time, you're better off giving them something in return and letting them go home for that non-productive time. The other option may not be a strategy in the short term, because remembering this short term, we're focused on cash generating activities. The other one, though, is to consider redundancies. Now, of course, if you make anyone redundant, you've got to pay out any leave entitlements they have, so annual leave, if they've been there long enough, on service leave. You've also got to pay redundancy pay. And again, for the longer period of time someone has been employed, those entitlements increase significantly, and it can turn into a very, very large cost. So it simply may not be a possibility to make some long-standing staff redundant because it's going to cost too much. But if there are some staff there that have only started recently, then it may well be an option to pay them out now and save on their wages for the next few months. And it works out. You've got to run the numbers, of course, but that may well be an option for your shorter-term staff. But for your long-term staff, you're possibly going to be better off on a stand-down basis rather than a redundancy if you think business is going to come back. And that, of course, falls back to the cash flow we spoke about earlier. Some other changes you could look at is reducing any non-essential expenditure. Now, it seems obvious, but there's some things you never know that you may not realise you're spending. Some of these may include staff perks. Let's say you're in a scenario where you've given your staff gym membership, or you've been providing breakfast or lunch or whatever the case may be, or transport. If you're in survival mode, this is not the time for luxuries, and those expenses need to stop. The staff may be unhappy, but again, there's a difference between them having a job or not. I'm sure they'll take the relaxation of the staff perks. It may only be a temporary measure, but a necessary one. Some other ones that sometimes people overlook is conduct a good audit of your IT expenditure, your licensing. You might be paying licensing for software for staff that left 2, 3, 5 years ago. There might be a whole stack of people that you're paying for their registrations because you've never bothered to go through the process of working out whether they're still employed and what license you're paying for. That could add up to a fairly significant saving. It's also maybe using platforms. You've changed platforms now and you're no longer even using that particular software, so you can get rid of all of those costs, for example. And also looking at your service providers. You might have an IT company that's charging you a retainer, but you really look at it and you work out on an hourly basis. They're only coming out a few hours a month, but you're paying this large retainer. Perhaps it's better to convert them to an hourly rate. Or to the contrary, perhaps you're paying them on an hourly rate, they're coming out a lot, and it would be cheaper to go on a retainer. So just looking at that, and that might apply across different professional services, not just IT. So that's another thing to consider as well. It's also a time to look at your marketing expenditure. Are you spending too much on your marketing? Now, I don't for a moment suggest you should stop spending money on marketing. In fact, it might be the time to really consider what you're doing in that space, because you're desperate for work to come in the door. If you're a business that hibernates, then clearly marketing may not be an option because no one's open. But you've got to look at what those expenses are. So, and look at the return on investment on them. For example, are you paying for Facebook advertising where you can't actually identify a single lead that's coming out of your Facebook advertising? Yes, it's all about branding as well, but if you can't identify a lead, maybe now's not the time to spend the money on Facebook. Are you still paying for white pages? Who uses white pages now? So again, what's your spend there? It all comes down to that return on investment and seeing it's giving you a direct link to your revenue. Then absolutely leave it in. You need everything you can do to get the revenue in the door at the moment. But for anything that's non-value adding, it's got to go. It's got to go. And there may be many other expenses, and this is just an exercise where the business owners should sit down with their advisors and go through line by line in their profit and loss, their expenses in particular, and see what doesn't need to be there. And sometimes they need a little bit of help. Business owners, what they think is a necessary spend may not necessarily be a necessary spend. It might be more of a luxury spend. So they've just got to be realistic about that. So that's certainly so minimizing non-essential expenditure is another strategy. Now, I want to talk about some of the debt deferral options. So this is, ones we've spoken about now is eliminating cash flow. So that's great. You want to do that. But now, if you're still in a position where you haven't got enough money there, looking at your cash flow, then you need to look at some other strategies. And this is where your debt deferral. These are the ones you want to avoid if you can. But if you need to, these are your options that are available. The first one is your bank assistance. Now, this is where you've got loan repayments perhaps with a bank that are paid monthly. The banks, as we know, are very open at the moment to waiving those monthly repayments. Your interest is still going to accrue, so it's going to cost you more money in the long run. So again, only do it if necessary. But the monthly savings on those loan repayments for the short term where you're unable to pay them because your business has been severely compromised can be the difference between being able to pay your wages that week and not being able to pay it. So in that scenario, absolutely take advantage of the relief provided by the bank. And this doesn't just go to the bank, this also goes to the ATO. The ATO are a big soft puppy right now. They are absolutely willing to consider any debt negotiation and repayment agreements. There might be some old tax debt that you were planning on paying in the March quarter, for example, but things changed so quickly that the money that you were going to use to pay that tax has quickly been used to pay other very urgent expenses. In such a scenario, get on the phone to the ATO, explain that to them and explain that you'll pay that debt off over time. But again, only if you need to. And that can go with any of your creditors. Have a conversation with them, just talk about them, about the scenario we're in, and just say, look, we can't pay your debt in full now, but this is the plan. This is how we propose to do it over the coming period, and just see if they're open to that or not. Hopefully you can work something out with them. And that includes your landlord, for example. Now, once you've got to this stage, you'll be in a position. So to remind ourselves, we've done a cash flow before taking advantage of these initiatives. We've looked at what government stimulus, because that's an easy grab, get as much of that as we can. We've then looked at eliminating non-essential spend and deferring other debt where we can. So that will present a picture to us. Is the business able to survive for the short term? Get through to the end of September where hopefully the revenue will start to increase again as these government restrictions are coming off. Now, so the numbers will present themselves. Once you do this, your cash flow is going to give you a big profit figure, well, not a profit figure or a loss figure. It's as simple as that. So, and that'll answer the question, can you survive? And if the answer is yes, you can, great. Get those changes done. If you haven't already, communicate with the relevant stakeholders. Now, of course, it's critical to continue to measure that. Once you've got this in and you've done your cash flow, at least weekly, you should be analysing your actual results with your projected results. How are you standing with that? If you're going better, great. Maybe you can start paying down, minimising some of that deferred debt. Start paying your bank loan repayments so that it doesn't rack up down the track, for example. If things are going worse, and you're making more loss than anticipated, maybe you've got to bring some other initiatives in. Maybe you hadn't quite yet stopped your loan repayments in the bank with the bank and it's time to do that. Things like that. So you've got to measure it as this goes along to be sure that you're keeping track of what's going on. If things are going very pear-shaped, you may have to make some drastic changes very quickly. You can't just, it's not a set and forget strategy. It's far from it. Now, what happens if you can't generate sufficient net profit? Well, firstly, can you hibernate if you haven't already? Is there any way to put it into hibernation, to just put everything on hold until you're comfortable, you're in a position where it warrants opening the doors again? That's your first strategy, and a sensible one. If that's not an option, or it's not going to resolve your situation, your landlord's not willing to give you any rent relief or something like that, then you need to look, do you have to look at closing the doors? That might be something permanently, but there's some effects of that, of course. So we're not suggesting necessarily you do that. But whatever you do, you don't make that decision at this point, because you need to look at the long-term strategy. Even if you're running a loss at the short term, depending on the extent of that loss, if you can see for the long term things are definitely going to get better and you're going to get back to making good profit, well then maybe you've got to look at just riding that wave until you get to that point, hibernating as much as you can, cutting back as much as you can to minimize that loss, just to get you through when you think it's going to get better. And that's where we'll move into now. The strategy needs to be considered short-term strategy and long-term strategy together to decide what you want to do with the business for the long term. So moving into the long-term analysis, it's a similar approach to that of the short-term. So I'll move through some of these reasonably quickly because they're quite similar to the short-term strategy. But the first, of course, a long-term cash flow. Same scenario. From September onwards, projecting out your strategy of your cash flow from there on. What is your expected revenue? And again, not an easy ask. We don't know what the government restriction easing looks like at that stage. You don't know how much it's going to come back. We don't know, depending on the nature of your business, what's that mean. So it's an easy thing for me to say, again, but one that you need to use your best endeavours and the business owners working with their advisors to get that as accurate as they can in putting that together. And again, being realistic, not optimistic, not looking at it through rose-coloured glasses, being realistic and objective in those projections. So first thing they're going to do is analyse the long-term cash flow. And that then, again, without any of these new measures that I'm about to talk about within place, and that'll show you whether it can make a profit on its own back then, because maybe it can. Maybe it's going to be back, it's going to be okay. It's a particular business that it's opened up and it's enough to start trading as normal, great. But it may be the case that it's not, and some further initiatives need to be considered. So this is where we go back to step 2 of identifying other measures to be made to the business. Now, we spoke in the short-term strategy about these cash generators initiative, including things like tighter debt collection policy, sale of surplus assets, and we spoke about the cash deferrer options, minimising expenditure, deferring off bank debt, for example. Now, if you can still continue with those, and you need to, absolutely look at that. What some of those strategies might cover over. Sale of assets and things, probably not. Once you've sold them, or you may not have that as an option anyway. But your tighter debt collection policy, absolutely, keep that in place. Keep considering discounts can be offered to get cash in the door. So there's certainly things you could still consider. And your cash deferral policies, again, considering minimising that expenditure as much as you can. But there may be some other strategies that are more akin to a longer term strategy and would work better with that. So some of those strategies might be a refinance. It might be a situation that the deal you have with your current financier, you can get a better one elsewhere. So that's, of course, a longer burn or longer term strategy. So that might be something you can look at. There might be some private equity funding. What about negotiating with new suppliers for possible new accounts with suppliers, or getting further discounts on the goods that they supply? I don't know, you might be a business that has a large refrigeration section, therefore your power consumption is through the roof. Have you considered what other utility providers that are out there? You might be able to save by going to a different utility provider that provides power at a cheaper rate or on different terms or something like that. So looking at all of your suppliers, can you get better rates elsewhere? Insurances, things like that. Playing the field a bit. Again, we spoke before about landlords and reducing your rent, but another strategy might be, is moving premises an option? It's not really a short-term strategy because, of course, you're going to have downtime, you have fit-out costs at the new place, you have fit-out costs at the old place, depending on how much incentive any new landlord might offer. But it still might work out well in your favour, particularly if you're coming towards the end of a lease or you're on a month-to-month. Maybe it's a much better idea to move. You've got to run the numbers, of course, because there will be costs associated with that move, downtime and the fit out costs I just mentioned. But if you're going to save significantly on it, that may well be an option. That is a long-term strategy to bring that rent cost down. Also, maybe you're occupying 4 sheds and you only need to occupy 2 sheds. Talking to the landlord, handing the 2 sheds back to him, allowing him to re-tenant those out, and you then just pay in that smaller footprint, again, saving rent. So they're the more longer-term strategies that you want to look at whether or not they're options, and looking at every dollar you can save. So let's say you've done that, you've looked at your long-term strategy and you've done all that. So that's great. And now you've got to look at, well, what steps did you take in that short-term strategy? In that short-term period, did you defer some debt? If you didn't, great. You skip this step and you move on. If you did, you had to, your rent, your ATO, your creditors, whatever it may be, you now need to come up with a strategy in terms of dealing with that deferred debt. And this is where you need to look at your cash flow. So you had a cash flow, a long-term cash flow now, it's now prepared. You've changed it as best you can with some of these other initiatives, the decreased rent or any other initiatives we've spoken about, to give you a new cash flow. And this will show whether there's any profit left over or not. And if there's profit left over, how can you use that profit to pay this deferred debt? That's the strategy you now need to look at. So this is where hopefully you deferred as little as you can, because now this is where you come back and it starts to bite. And you need to be sensible, I suppose, with this strategy, in that you don't just necessarily want to go, all right, well, my rent, I've got, we deferred $50,000 of rent over this period. We've got 2 years left on the lease. So 50 years divided by 24 months, that's how much we'll pay each month. No, because in all likelihood, these first few months are going to be tough. Remembering when we come out of this in October, business, for many businesses, isn't just going to go back to the way it was. Hopefully for some it does. But then, of course, we're into Christmas. 2-3 months and we're into Christmas. If you're a manufacturing business, seasonally, you shut down there. So you're not going to produce income. If you're in retail and hospitality, great. You're going to get an opportunity to make up some lost time. So it depends on the business that you're in, of course. But you need to look, so going back to the rent discussion, it might be that you say to your landlord, look, we'll pay $500 a month for the first 6 months, and then we'll bump it up to $750. This is over and above the normal monthly rent, of course. This is making up the old debt. So you do a sliding scale in the hope that your revenue starts to increase, and then you sliding scale for all of your repayments as well to match that. There's no point putting repayment agreements in place that you cannot afford, because remember now, we've come out of September, that protection of insolvent trading that we have had up until then has gone. The government stimulus has gone. The banks now want their loan repayments made, potentially. So you've got to find this money to start standing on your own 2 feet again, all potentially on some decreased revenue. So you need to set up a plan that's going to work. And this is where working at what that profit is and using that profit to pay this deferred debt properly, and setting a strategy and talking to your stakeholders. This is the most critical step here. This will be the difference between your business coming out of this and not coming out. The ones that put their head in the sand and just think, I'll get there and I'll deal with it then, are going to have problems, because if they don't put these things in place now, creditors may well take action to wind up their businesses, and then they lose all control of the process. So they need to be looking at these matters now, doing these cash flow projections now. So they do that, and they then determine, set these wheels in motion and work out, okay, with this much profit, I can pay down this debt in these strategies. I can pay this much to the ATO, this much to my landlord. Great, I can make it work. Excellent. You implement the strategy. So the next thing you do, which goes on to the next step, is you discuss it with the relevant stakeholders that are involved. This is anyone from your financiers to your employees, any key suppliers that this affects, your landlord, of course, if it affects them, the ATO, again. You need to communicate with them upfront. You need to get everybody involved and everyone knows exactly how this is going to work, and you document it. So there's no confusion on how this process is going to work going forward. You want your employees to know, because you want buy-in from them. They're on the journey with you as well. And if they've supported you to now, they're going to support you for the future. So that's the strategy. And then you talk to those people, and then of course you move into the next stage, which is simply to implement that strategy. Have those discussions. Get your advisors involved to help you with that. And that's hopefully the outcome that businesses will find themselves in if they take these steps now. What about those ones where, when they're looking at the long-term position, they've done the long-term cash flow and there's not enough profit there to pay down the deferred debt. They've done everything right, but it's just simply not there. That's where you want to look at one possible avenue from there on in might be a formal restructure. And I'm going to take us through now, just quickly, a case study, a hypothetical scenario that I've prepared, just to show you how that might work. Again, this is not something that is going to work for everybody, and not something I'm suggesting everyone does. This is your last stage you get to, where you've done everything we've spoken about to now, and there's just simply not enough there to make it work. What can we do to give the directors or the business owners some confidence to continue to trade on? Because the ultimate goal here is to keep this business going. So we're going to talk about a manufacturing business. This is hypothetical. This is not a real scenario, but it's loosely based on scenarios I've been involved with. So it's a very real one, but it is not a real one in that sense. So it's a manufacturing business. Let's assume it's been suffered a 50% decrease in revenue for the short term because of what's going on in the current environment. Then the directors have done everything right with this company. They've reduced expenditure, they've negotiated and deferred all the debt, because if they don't do that, they don't make it for the short term. They've deferred everything off. They've got some old tax debt there they've had to defer off. They've got some old supplier debt that they thought they'd be able to pay, but they couldn't. They had to use that money to pay the wages because the income slowed down considerably. So the directors have done everything right. And in doing that, they've worked out with the government support, they can make it for that short term. It's very tight, but they can make it. They can, with everything, they've got staff on reduced weeks and things like that, they make it through. So that's great. But then they've done their long-term strategy, and they've worked out with this deferred debt at the level that it is, and the decreased revenue that they expect is going to present itself to them once they come out of this. They feel it's going to be a longer time before they start to bounce back to where they need it to be. They haven't got enough money to pay the deferred debt. They've got enough money to pay the current debt. They're a profitable business if they didn't have this old debt. It's just the old debt that's causing them the problems. So how do they go about dealing with that? So one possible scenario is you appoint a voluntary administrator. A voluntary administrator is an external party that comes in and they take control of the business for a very short period of time. If this all goes well, they might only be involved for 4 or 5 weeks in the detail. They come in, they secure the assets. They then look at the ongoing trading position of the business, of the company, to work out, can it continue to trade? In this scenario, I've given the example of saying, yes, it can. It can make it for the short term. So with the prospect of putting a proposal to the creditors to keep the business going for the long term. So the administrator will look at that and go, okay, great. Well, let's keep this business going to facilitate that process. Let's give it every chance we can. So they'll do that. Their role then is to look at what recoveries might be available if it goes into liquidation and the doors close. Because what happens at the end of all of this administration process, which runs for about a month, the administrator will present 2 options to the company's creditors. The creditors control what happens. One will be, if we liquidate the company and close the doors, this is what will happen. The other will be, this is the proposal that the directors want to put forward to keep the business going. That's the ultimate goal. And at that meeting, the creditors decide which one of those they want to choose. So to do that, the administrator needs to work out what would be available in that worst case scenario, and they'll present that information. And I'm going to give you some figures in a moment to show you how that might work. And then they'll also take the step of working with the directors to formulate this proposal, to come up with something that hopefully is acceptable to creditors. So I've run up some numbers here. So manufacturing, it's intentionally simple, just to get the principle across rather than the detail. So we've got a business here that's got plant and equipment. It's a manufacturing business, as I said. So plant and equipment, office furniture, stock, some debtors. They've got some good customers to pay, $150,000. So in this example, I've said the total asset pool book value, this is on the books, or this is not what you would get in a liquidation scenario, is $370,000 of book value. Now, the administrator quickly comes in and values everything. They get external parties to value it all and work out what would be available in a liquidation scenario. And they come up with these numbers here. So the plant equipment and office equipment, roughly worth about half the book value in this example, and that's not necessarily uncommon at all. The stock is only worth about 20% of its value because it's raw material sitting on the floor. It's not worth a lot. It needs to be converted to make it valuable again. So whilst it's valuable to that business, it's not valuable to anybody else. The debtors, we've suggested in this example that they're fully collectible. It's a good business. It's a solid business, been around for a long time. Its customer base are very loyal, so there's no reason the customers won't pay for the work that the business has previously done for them. So that gives a total recovery, if you were to close the doors, of $240,000, $245,000. We're saying the liquidator's costs of then dealing with everything. This includes trading the business for the month. This includes going through the close down process, collecting, selling all the assets, calculating the employee entitlements, conducting investigations into the background of the business and everything. It's a 6 to 12 month process. That's what we're suggesting as a rough estimate of what it might be in this scenario. Now, this is where a big issue happens. It's the employees. So we're saying in this case, there's $120,000 left over. So you've got $245,000 of recoveries, $125,000 in costs and liquidators costs, leaving $120,000. The figure for employee redundancy here that I've put in is $250,000, and this is not unusual at all. It's a good business, long-standing employees, therefore they have large entitlements. They've got long service leave to be paid out. They've got annual leave to be paid out. And critically, there's redundancy. And if it's all happened very quickly, there might be pay in lieu of notice. It is very easy to get to that kind of number for a small number of employees. This is only a small business. You're talking 15 employees. And these are the kind of numbers you can get to very quickly. And that's the problem here. If you close the doors and everyone gets made redundant, it's a big pay packet that needs to go out the door. And this company can't afford to do that. So in this example, what happens is there's not enough money in the company to pay those creditors. So the government steps in. Employee entitlements are always paid, except superannuation, and there are caps, but there's a government program called Fair Entitlements Guarantee, FEG, that will come in and pay out the employee entitlements. So the employees will always get looked after, but they then just step into the shoes. So any money they pay out, they get reimbursed until they're paid out in full. And anything left over goes to the balance of the creditors. In this example, there's not enough to pay the employees, so the creditors will get nothing. So that's the bad position. That's what happens if you close the doors, and that's what we need to avoid. So the administrators then work with the directors to formulate a proposal. In this proposal, we've come up with the example of they make a contribution of $50,000 out of the debtors. I mentioned before there were debtors of $150,000. I'm saying they're going to hand 50 of that over to the deed administrators, if this goes through, to pay for those employees they need to make redundant now. They have to make the difficult decision of letting some staff go now, and they acknowledge there's going to be a redundancy cost with that, so they carve out and set aside money to deal with that. So that's great. The employees get looked after in the first instance. The remaining $100,000 they keep for working capital because they need that to pay the bills. Then we move on to the contributions. So they're going to pay monthly contributions under this deed for a period of 18 months, but they can't start yet. The reason for that is they're coming straight out of this. The revenue hasn't recovered yet. It's a manufacturing business, so they've got October, November. Then all of a sudden they find themselves into December and January, Christmas. They're closing down. They haven't got the ability to earn any income. So they're saying their first contribution will be in February 2021, providing them time to get the business back up and running. Now, the downside of that, of course, is that means the creditors don't get any money for some time. But the company is unable to afford anything earlier. It's a scenario here where we're talking at the lesser of two evils. The creditors are not going to get all their money. It's at that point the monthly contributions will start, February 2021, and they'll be going to be calculated on 50% of all net profit in this example. So if they have a good month, half the money gets paid over to the deed administrator. They keep the other half in the business as working capital to keep it going. And the advantage of this now is the directors have confidence that they can afford these payments every month. If they have a bad month, they're not running around worried that they're not going to be able to find the money and the whole thing's going to fall over. So they just pay a lesser amount. But on a good month, they have to cough up more and pay more over to the deed administrator. So the creditors get the benefit of it. So it's win-win. So in this scenario, I'm saying that they're going to do that for 18 months after February 2021, providing figures of 300,000. Now they sit down and do all these cash flow projections with the administrator. It's a complex process. So I am intentionally simplifying it. But in this case, that would provide a return of 64 cents in the dollar to the creditors. And I'll show you how I've come up with that. So that final column there on the far right, I'm saying they're contributing 50,000 of the debtors for those employee entitlements. They're then contributing an additional 300,000 over the 18 months that I mentioned, providing a total pool of $350,000. They then have VA, voluntary administrator and deed administrator costs of 75,000. They are considerably less than the 125 because there's no sale of business. There's no investigations to be undertaken. Everything gets tidied up a lot faster, so the costs are significantly less. This leaves $275,000 left over. The employee entitlements are only $50,000 because they only had to terminate a small number of staff. The rest of them have still got a job. So once you pay them out, you're left with $225,000. Amongst $350,000 worth of creditors, they get their 64 cents in the dollar. Now, the big benefits of a formal restructure like this are as follows, and these are quite important. Firstly, to do this, we've acknowledged the business cannot survive for the long term without taking some steps. So this is only for those businesses where they've identified that. Now, if they don't, what's going to happen if they don't take steps? After September 2020, the insolvent trading regime steps back in, and the directors, if the company ends up in liquidation later, can be held personally liable for that insolvent trading debt. And what that means is they're now putting at jeopardy personal assets because they can be personally sued by a by a liquidator. So they're now jeopardizing their personal assets. Critically, creditors are bound by this process. So I said before, when you come out of this at the back end, if you don't keep all those creditors happy, they can wind you up. The insolvency law suspension has gone and they can take action to wind up the company, which would force it into liquidation, which as we saw on those numbers is not the way we want to go. Under a proposal, if creditors vote to accept it, you need a majority of creditors in number and a majority of creditors in value voting in favour. If they vote in favour, creditors are bound, so there's no concern from the directors. They know their business is safe from being wound up. So as such, they can proceed with focusing on getting the business back and running as it should be and making money. The contributions are affordable because they're tied directly to that net profit that I mentioned before. So there's no concerns from the director's perspective about being able to pay them. Critically, the business continues, and the flow-on effect from that is, firstly, employees keep their jobs. We've just saved another $200,000 that would have had to be paid out to these employees if they'd had to be made redundant. So there's $200,000 saving there, plus they've got a job. They're not standing in the queue at Centrelink. They're not having to seek welfare from the government or trying to find new jobs. So that's a big step in the right direction. The creditors keep a customer. Okay, the creditors are going to miss out on some money, unfortunately. But if it goes into liquidation, they get nothing. And on top of getting nothing, they lose a customer. If this business keeps going and they've right-sized it, they've used this opportunity to get rid of those employees that aren't going to, that they can't afford to keep on, potentially change their product offering, for example, use this to give them that second fresh start. The business will have to be profitable, otherwise the administrator wouldn't have provided any support to the proposal. So they've had an independent party review that. In all likelihood, this business should hopefully survive going forward. So the supplier keeps the customer. They keep supplying that business going forward. So they'll make more money. They've got a customer. Otherwise, they lose that customer as well as lose all their money. Creditors will receive most of their debt, as I said in this example, 64%. It's not all of it. And they're not going to get it for 18, well, by the time they take into account the extra 4 months at the start, they're not going to get it for almost 2 years. All of it. They'll get some of it along the way. So that's going to be hard on their business, but the alternative is they get nothing. So it is the lesser of two evils. The landlord keeps a tenant. This is critical. If the business closes, they move out, the landlord has to find a new tenant. And if the landlord has 3 years remaining on the lease, they're then owed the money for that 3 years on the lease, and they can make a claim in the liquidation as well. But as we've seen before, they're not going to get any money. So they've now got to find a new tenant. And as I said before, if it's not accepted, the company ends up in liquidation. So, and the good thing about such a process, it can be done in 4 to 5 weeks. It leaves a minimal footprint on the business. Now, just the last thing I want to touch on just before we finish up is just the fact that how important communication is. Communication is important in any business that's doing well. Everyone needs to be on the same page of what the business strategy is and things like that. It needs to be regular, informative, and of course across all these key stakeholders that I've got on the screen. But critically, when times are tough, it's more important. There's no point going through all that we've discussed today. One director sits down with their accountant, comes up with the strategy, is across the numbers, and they implement it. And they haven't spoken to the other director. And the other director doesn't know what the strategy is and does things to compromise the whole thing. Everyone needs to be on the same page. And that same message needs to be communicated to all these stakeholders that are there. The CFO, the bookkeepers, they need to know what's going on. If you're changing debt collection policies, you need to be communicating that to them. The customers need to know the same things. Employees, you want their buy-in, you want their support. They want to help. They want to do their bit to keep the business going so they can keep their jobs. So that's where this communication piece is absolutely critical in going forward. And look, that's my hour, so I will finish up there. So
Thanks,
thank
Chris.
you very much.
Thanks, Chris. That was absolutely fantastic. I mean, not only information great for what we're going through at the moment, but I think just in general for businesses to actually stop and have a look at their businesses, where their expenses are and where things are going at. Because as you say, subscriptions is a really big one. We did have one question there from Leanne. Now, Leanne asked, what about accessing your personal super to prop up your business? Is this a good or a bad idea?
I struggle with this whole accessing super personally. It is. I know a lot of people have done it, and we've all, well, particularly me. I'm a boring bean counter. I've run the numbers previously on how important it is to stack your super up. The more you pay now, exponentially at the other end, of course, you make a much better place for yourself and the income that will serve for you. With investing any money, whether it's super or not, is it going to make a difference? We see too often businesses come along and they'll get a loan from a family member, and this is the worst thing that they can do. They'll get a loan from a family member. They won't document it properly. It won't get the security status that it should get. And all it does is plug a hole for the business to trade for another 6 months. They don't fix the underlying problem. And as such, the thing falls over in the end. And the only thing that's happened is the family member has now lost the money that they've put in. So if someone was going to invest any money, whether it's from superannuation or elsewhere, they want to be sure that that money is going to make a material difference and it's not just kicking the can down the road a bit. So for me, it's all about what is that going to produce before you go and invest personal money. It's super is still that person's money. So are they prepared to put their own money in? Because they're going to want to see that money come back out. And if it just goes into a hole, then it doesn't achieve the result, and they're going to lose that $10,000.
Yeah, really good point to make. So I think there's been a lot of businesses actually asking about what they should do with their super in relation to putting it into that business, and it is a risk, and it's probably where they need to get some advice from some people. Obviously, they don't always have the answers. So if anybody watching here today wanted to get in contact with you, Chris, what's the best way that they could do that?
Certainly, probably go to our website in the first instance if they'd like. It's at worrells.net.au, and Worrells is up on the screen to spell it. And they'll look at the contact page and look up Chris Cook, or just send me an email, and I can contact them at chris, CHRIS.cook, COOK, at worrells.net.au. And happy to answer any questions. I'm quite passionate about this point because I am very concerned about businesses not being proactive, and I do worry about people putting their head in the sand for this period.
Now, if you enjoyed this presentation and you'd like to see more, we encourage you to head to our website at www.bycc.com.au. If you register your details to receive our newsletter, you'll hear about all of the upcoming events that are happening, or you can simply go to the event tab to find out what we've got coming up. We hopefully will see you at the next event.